Rippin It. I'm here with Derek Ripp, where every week we get together and we talk about something that's going on that everybody's talking about regarding economics, personal finance, investing. And today's topic is born of a Wall Street Journal article earlier this week. The content was out of Fidelity. And what they reported on is that somewhere between 20 and 30% of Fidelity customers sold all their stocks in about the first 30 days of the crisis. And the chart showed more specifically that the older the client at Fidelity, the more likely they were to have sold. So people in their 70s, I think, around 30%, and people in their 50s and 60s, were a little close to 20%. But that's a lot of people selling stocks at arguably the worst possible time. They thought differently. And some other stats, the peak of the market, the last peak was February 20th. On March 23rd, that was the low point, the current low point, we might call it the bottom. The market bottomed out at 35%. That's the U.S. stock market. And today, June 19th, by the same measurement, the U.S. stock market is down about 7%. So if you were one of those poor folks who sold when the market was down 20 to 35% and didn't immediately buy back in, you're currently sitting on a pretty significant loss. So Derek, I pose this to you. What are the conditions when it does make sense to sell?
Yeah, it really depends. The best time to sell is when you don't have to.
Yeah, I think that's well summarized. I think it was either Warren Buffett or Charlie Munger. If it wasn't one of those two guys, it sounds like something they would say. When the same question was posed, the answer that was given was, you should sell stocks when you need the money to spend, or you've given up on capitalism.
Right. Yeah. Well, let's hope that that's not the latter of the two, because if we're not in that type of system, I don't know what kind we are in. But it's a valid point. You always want to be in control. You want to sell on your terms and let the market come to you. Unfortunately, a lot of people don't think about liquidity. Life happens. They're forced to sell. They're forced to raise assets because they need the money, which may or may not be at the right time. With the markets, the markets could be down 30%, which would be the absolute worst time to sell. So, being patient, and the other part, the big part, which you were hitting on the front end, is, the behavioral finance aspect of investing. And I have to believe that a high percentage of those people that sold in that Fidelity article you referenced were selling based on emotion, which again, more times than not, is going to work against you when you're trying to sell based on your gut feeling.
I like to use something I call the 5-year rule, which is to say, if you're going to buy a stock today, make sure that you don't have to sell it for at least 5 years. And the reason I like 5 years is because if you look back in history, any 5-year time frame, about 90 to 95% of 5-year periods, you at least get your money back on stocks. In other words, even if there was a downturn or recession, after 5 years, even if your timing was just terrible, you typically have at least your money back, if not a positive return.
Yeah, I think that's a great rule of thumb, and the odds only improve the longer that you hold those assets. So if you can wait 10 years, the odds look even better. And that's really the position that are ideal for investors, is to have that, to be in control, to not have to sell, to not sell based on emotion, but to sell when the timing's right for you. And sometimes selling is not the right answer at all. sometimes it might be that you don't want to sell, you want to hold an asset. From an estate planning perspective, you want to hold an asset so you can pass it on to the next generation. One of the biggest tax benefits is the step up in basis. So for clients that may own real estate, other assets that they have a low cost basis in, the answer may be not to sell it, but to hold it and to pass it on to the next generation, because the cost basis gets reset upon death. And so that can be a really effective tax planning technique and estate planning technique as well.
Another way to look at it is, rather than selling to get away from risk, another way to go about it might be to instead buy assets that could do better if some kind of major risk materializes. We tend to call that diversification, which has not served as well as some hope during these extreme types of situations. But there are certain types of asset categories that tend to perform well. The one that comes to mind is gold. Another that comes to mind is managed futures. It's essentially a trend following strategy that goes long and short, and if the market's going down, sometimes those trend following strategies actually make money. What are your thoughts on, instead of selling out of fear, introducing some types of asset categories that may allow you to do better without going to cash?
Yeah, that's a great idea. And part of diversification is that something is basically with diversification, you own different asset classes that typically do not behave in the same manner, or not directly correlated. So in order to be properly diversified, you're typically going to own asset classes that don't do well, for example, or as well when the stock market is going up. And so you have to be disciplined to be an investor and have a diversified approach. But the nice thing about that is there's usually an asset class that's on sale. And what I mean by that is, it's great to be on the other side, of the table, to where you're in a position where you can buy assets when they're on sale, instead of, having to fear and try to sell them essentially when the markets are going down. That's really the position that, the successful investors are in, that they are going opposite the trend. They're contrarians, and they're buying assets when everybody else is, panicking and selling.
Earlier, I mentioned that the U.S. stock market, the total stock market, as of today, June 19th, is down 7% from the last peak, which was late February. During this time, we've been through a pandemic. We're still in the middle of that, I think. We had a collapse of the energy market, where prices fell further than anybody imagined possible. A lot of that was political issues. We've also had a societal breakdown, manifesting in the form of protests, riots, in some cases turned violent, destructive. It's strange times we're in, and we're only down 7% in the U.S. What do you think is the biggest pent-up risk in markets and the economy that could possibly lead to a significant sustained recession? If you had to pick one, what do you think is the biggest and most likely pent-up risk going on right now?
Well, it's a great question. I would have to say that the greatest risk is that the economy does not bounce back as quickly, as strongly as anticipated. Because if that happens, and there's a lot of dialogue about what type of recovery we're going to have, whether it's a V or W or L, or there's all kinds of letters that economists like to throw around that kind of describe the shape of the recovery. But the biggest risk is that it's a slow, drawn out recovery, and essentially more government measures might have to be introduced, more liquidity, more printing of money, uh, more stimulus. And I think that could also have an impact on long-term impacts on the dollar, on inflation. And so, right now, it seems like the moves that have been made have helped the market. I mean, the reason why we're only down 7%, I think, is attributed to how quickly the government stepped in and how the Fed cut interest rates and how the stimulus package was passed quickly to get cash in the hands of small business owners. So to their credit, I think the market has bounced back as a result of that quick movement. But ultimately, we don't want continuous stimulus or continuous money printing, because that has its own long-term and negative implications.
That's where I think the biggest risk is the long-term effects of the trillions of dollars of stimulus money printing coming out of the Federal Reserve. There's just no telling what type of catalyst would turn that into a disastrous situation. Certainly, if interest rates increase, all that debt that's been created is now far more expensive, and that's a problem. But many will tell you that we're heading for negative interest rates, not just zero interest rates, but possibly negative interest rates. So the maybe the threat of higher interest rates is nowhere on the table, except for in the area of credit risk. So it may be that Treasury bonds remain zero interest rates or negative interest rates even. But credit risk is something different. And we saw this really spike during the early stages of this recent crisis, where the interest rates on corporate debt, companies that can go bankrupt and go out of business, spiked dramatically from 2% to 6 or 8% interest rates in a very short period of time. So in one sense, the Federal Reserve does move the needle on interest rates, but the market also prices interest rates based on risk. And a big concern I have is the percentage of corporate debt has exploded for the last 10 years. So if we start to have large-scale bankruptcies, defaults on corporate loans, I'm not sure what kind of effect it would have, but it could be pretty bad. So let me ask you one last question on the topic. If you and I share concerns about these calamitous possible outcomes, not sure when or if they'll happen, but if we're just concerned about it, and selling is not a great strategy, how would you prepare somebody if they're really concerned about markets blowing up at some point? And we don't have to be specific about when or how bad, but if somebody's just really concerned about that and they want to be prepared, what is the number one piece of advice you'd share with them?
Yeah, a few things. One, we always want to try to provide education and provide some insight. I think a lot of times education goes a long ways to helping to calm nerves, and just being able to review some of the data historically helps. Just like we were talking about earlier about the time in the market. Just having that time in the market improves your probability of having a successful outcome. That might be one example. But also we have the ability to customize recommendations for our specific clients. And so a particular client that might have those concerns, we may determine based on their financial plan that they need to be in the markets. They need to take some risk in order to sustain their portfolio through life expectancy. But there's different ways to take that risk. We can design a more defensive type portfolio that is using more lower volatility names, consumer staple names that will take some risk and that volatility down in their portfolio. So I think it's a combination between understanding clients' goals, objectives, what's the required rate of return. In other words, what do they need their portfolio to do? But at the end of the day, we can always customize to try to structure their portfolio to meet, to make them comfortable and so that they sleep well at night.
I agree with all of that. And I'll just add that going to cash is not a risk-free decision. Going to cash does not mean you've escaped risk. And the reason I say that is because the real return on cash, meaning the increase in your ability to buy stuff with cash, probably -2 to -3% per year compound. That's because of inflation. So if you're going to cash, you're destroying your own wealth over time. And to your point, if a household needs a 6% or 8% compound return over the next 20 years to make everything go, there's no way that's happening in cash. So cash is the way out.
Yeah, I mean, not in cash, not in bonds either. So you're going to, a client in that situation is going to have to take some equity risk. And then it's a discussion of, how do we structure this equity and what types and, percentages, U.S. versus international, et cetera. And that's a whole nother conversation on portfolio construction. But to your point, cash is definitely not going to do it. And bonds, you're probably going to break even with inflation. So you're just, treading water if you're only making, 2 to 3% in a bond portfolio.
Derek, thanks for ripping it with me on a Friday. Have a good week. Talk to you next week.
Always a pleasure. Take care.